My neighbor called me at 8 in the morning last year. He was panicking. यार मार्केट बहुत गिर रहा है, मैंने आज अपना एसआईपी बंद कर दिया, तो भी कर ले. He had been investing 10,000 rupees every month for 3 years. Disciplined, regular, never missed a single SIP. And in one phone call, one morning of red charts and breaking news, he undid everything. Here's the truth nobody tells you when markets fall. The people who panic and stop their SIPs, they lose money twice. Once when the market falls and again when it recovers without them. Today, I'm going to show you exactly what happens to your money when you stop your SIP during a crash and why most Indians make the exact wrong decision at the exact wrong time. Picture this. You wake up, open your investment app, and your portfolio is down 18%. 2.4 lakh invested, showing 1.96 lakh. That's 44,000 gone on paper. And then your phone starts buzzing. WhatsApp groups, news articles, relatives, everyone saying the same thing. Market और गिर सकता है, पैसा निकालो. So what do? You do what feels logical. You stop the SIP. Maybe you even redeem some units. After all, why keep putting money into something that's falling? This is the most natural reaction in the world. And it is also the most expensive mistake you will ever make. Because here's what nobody explains. The entire reason SIP works is precisely because the market falls. Let me show you what I mean. You are buying more when prices are cheap. When a mutual fund's NAV drops from 100 rupees to 70 rupees, your 5,000 rupees SIP buys more units. Before the crash, 50 units. After the crash, 71 units. Same money, 21 extra units for free. Ab soch lo, if the market recovers back to 100 rupees, those extra 21 units are pure profit. This is called rupee cost averaging. It's not magic, it's just mathematics. But it only works if you stay invested. The moment you stop buying the discount. The 2020 numbers that silence every doubt. In March 2020, the Sensex crashed 38% in just 6 weeks. Full COVID panic, everything red. Over 40 lakh Indians stopped their SIPs that month. Real number, AMFI data. Now here's what happened next. By December 2020, just 9 months later, the market had fully recovered. By December 2021, it had gone up 120% from the crash bottom. The people who stopped their SIPs in March 2020 missed the single biggest wealth building window of the decade. The people who stayed or even increased their SIP doubled their money. Same market, two completely different outcomes. Only difference was one decision. Stopping is not protecting money, it is locking in a loss. When you stop your SIP and redeem during a crash, you are selling units you bought at 100 rupees for 70 rupees. That loss is now permanent. The market can recover all it wants, but those units are gone. You sold them. And the cruel part? Most people who stop during a crash wait for the market to stabilize before starting again. But by the time it feels safe, the NAV is already back to 90 rupees, 100 rupees, 110 rupees. They missed the entire recovery. They bought high, sold low, and then bought high again. That's not investing. That's the opposite of investing. Here's why this keeps happening to smart, hardworking Indians. It's not because you're bad with money. It's not because you're irrational. It's because every piece of media you consume during a market crash is designed to make you feel fear. Breaking news, red tickers, words like bloodshed, crash, collapse. Nobody runs a headline that says, "Great time to accumulate cheap units." That doesn't get clicks. Your brain is doing exactly what it was built to do, protect you from danger. But a temporary market dip is not danger, it is opportunity. And the entire system profits every time you can't tell the difference. The investors who build real wealth aren't smarter, they are just calmer. They've seen this before. They know this chapter ends the same way every time, with recovery. So when the market is crashing and every instinct says run, here's what you do instead. 1. Delete the news apps from your phone for 1 week. The market doesn't care if you watch it, but your anxiety does. 2. Do not open your portfolio every day during a crash. Check it once a month, that's it. The more you check, the more you panic. 3. If you can afford even 500 rupees extra, increase your SIP during the crash. Not forever, just 2 to 3 months. You are buying a sale, treat it like one. 4. Write this rule right now and stick to it. I will not stop my SIP unless I lose my job or face a genuine emergency. That single rule will make you wealthier than 90% of Indian investors. No complicated strategy, no stock picking, just stay in the SIP. Remember my neighbor who stopped his SIP during the crash? He called me again 6 months later. The market had recovered. He had restarted his SIP at a higher NAV than when he stopped. He didn't lose money because the market crashed. He lost money because he listened to the noise instead of the math. Markets will always crash. That's not a risk, that's a feature. It is how compounding creates wealth for people patient enough to stay. The question is not whether a crash is coming. The question is, when it does, which kind of investor will you be? If this video changed the way you think about your SIP, send it to one person right now who you know is panicking about the market. It might save them from the most expensive mistake of their financial life.